Hey everyone, it's Ben Hardy here, and in today's video, I'm talking about credit availability for cars because we've got some important data on what's happening with auto loans currently. Before we get in this video though, as always, if you want to save time and money the next time you purchase a car, link to my car buying guide in the description down below. And then if you want to see more videos just like this, then I recommend you subscribe because I post content every single day. Let's get into it. So this data set comes from Cox Automotive, and the big headline is that auto credit was actually easier to get in February than it was in January. There was an increase in availability by about 0.9% month over month. However, year over year, credit was tighter by 4.4%, or access to credit. So what that means is that month over month things are getting better, but year over year, well, it's harder to get credit now than it was a year ago. And even when you compare to February of 2020, it was easier to get credit back then than it is today. So overall, things are improving, but they're not as good as what they used to be. And here's a little credit chart, as you guys can see. So that big increase upwards was basically when it was really easy to get credit over the course of the pandemic, and then obviously things slid down a massive amount because lending institutions tightened a bunch, and now we're basically back on the up and up where credit is becoming easier to attain again. However, it's not all good news because the average interest rate paid from January to February increased by 0.37. So although it was easier to get credit in February compared to January, well, credit was more expensive in February. But the thing that I find the most interesting is the overall approval rate and then the amount of subprime buyers. So overall approval rate increased by 0.2 percentage points in February, but year over year was down by 2.1 percentage points. So people that are going out and getting credit, more people are getting approved, but still year over year, less people are getting approved. However, the big thing is subprime buyers. So with subprime buyers, the share increased from 10.7% in January to 11.9% in February. So there are a lot more subprime buyers out in the market that are getting approved with credit, which, we'll talk about that a little bit later in the video. And then the next big thing that's important is the amount of buyers that have an auto loan that's greater than 72 months decreased by 0.8 points, and year over year was down by 0.8 percentage points as well. And so what this means is that we basically have more people with bad credit that are getting approved for auto loans. However, the average person is basically taking out a shorter term auto loan compared to what they were doing at the same time last year, and even month over month as well, which is good. Now, the last bit of data to go over is in regards to the lending institutions themselves. So year over year, everyone has tightened. However, it's not all equally spread. Credit unions have tightened the most, so it's really difficult to get an auto loan from a credit union, but it's pretty easy. Well, I shouldn't say pretty easy, but it's easier rather to get an auto loan from a bank or from an auto finance company, right? A company that's dedicated to financing auto loans. And so this shows that there's kind of a split, I guess, in the market. Okay, sorry, I lied. There's one more bit of data to go over, and that's the fact that auto credit loosened more on new cars than it did on used cars. And so what this means is that it's easier to get an auto loan on a new car today than it is to get one on a used car today. And this finally leads me into talking about why this is happening and what this means for the car market. So first off, on that last point where I just talked about how it's easier to get an auto loan on a new car compared to a used car, it actually makes complete logical sense with what we are currently experiencing in the car market. Right now, new cars on average are finally selling for under MSRP. If you look at the same time last year, on average, they were selling for over MSRP. So it makes sense as to why it was harder to get an auto loan on a new car last year because, well, banks don't like to give out loans for over MSRP on cars. If you don't know, lending institutions look at the invoice on a new car, and that's how they lend on that car is based on the invoice. And so if a dealership is charging over MSRP, then, well, the dealership is asking that lending institution to give them a loan to that customer for more than what the lending institution values the vehicle at, right? It puts the whole loan to value thing out of whack. And so, again, it makes logical sense as to why these new cars are easier to get with auto credit because, well, on average, they're selling for under MSRP, which means the loan to value is a little bit better, but that's not actually the full story because the report also stated that negative equity has increased by a pretty large margin. And this is something that I've also talked about on the channel. And so This is kind of a weird situation where you're going to have some buyers that have no problem getting approved for new cars because they don't have any negative equity coming into the purchase. And so then loan to value is in line because the dealers are finally not charging over MSRP. And so it's like, boom, instant approval. Whereas other buyers that are coming in with all this negative equity, it's making it so it's a little bit more of a rough situation. And so I think that's why we're not seeing as much loosening as we could, is because of that wave of negative equity that's flooding especially the new car market. It's easier to get out of negative equity if you're purchasing a new car versus a used vehicle, just because of how loan to value works and because of how much markup dealers have in new cars versus used cars. There's always more markup in new stuff versus used vehicles. And then when it comes to used vehicles, with basically lending tightening on them, it actually also makes logical sense with what we're seeing in the market today, because right now used cars are on the up and up again, right? I've talked about how the wholesale values are increasing. Retail values and book values lag behind wholesale values. And so right now we have a situation where used cars are now more expensive today than they were, a month ago or 2 months ago. And so because the book values and the retail values haven't caught up yet, lending institutions don't want to lend out more money on these more expensive used cars, right? They're going to wait for those book values to catch up. And so when you have dealers that are now trying to sell these used cars for more money again because the values have gone up again, well, it makes it so it's a pretty difficult situation when it comes to loan to value. And so, yeah, that makes sense why it's tightening with that market. Now, in terms of what this means for the overall car market, frankly, it's pretty mixed. So with the used car market, this loan tightening year over year is actually going to continue to put a little bit of downward pressure. Now, I don't see used car prices going back down. I see them continuing to increase with everything that we've been seeing on the wholesale market. However, the price increases are somewhat being throttled by the fact that you have a lot of people that aren't buying used cars just based on the fact that they can't get approved on the cars because lending institutions don't have updated book values yet with these recent price increases. And so this could basically cause a situation where once these values get updated and once these people can get approved, because again, you've got the new book values, you could see kind of like a little bit of a spike in used car prices because you'll have a bunch of people that'll finally be able to purchase these used cars that they've been, trying to get approved on and they cannot get approved on. Now, when it comes to the new car market, it's too soon to really tell, but with credit availability becoming better and better with new cars, that could put more buyers into the new car market if we see more incentives from manufacturers and more discounts from dealerships. Again, new car prices are still so far out of reach for a lot of people that even if it's easier to get approved on the new car, right, the payment that the person is, basically offered on that car is just way too high. It's way out of budget. And so, again, like I said, it's too soon to tell, but I could see this, basically putting, I guess, some upward pressure on the new car market, not in terms of pricing, but in terms of volume. Again, if we start to see a little bit more on the discount side of things from both manufacturers and dealers. And then when it comes to that data set that was talking about subprime buyers, I think this is very important because this is showing a huge market shift to where we finally have subprime buyers. Again, over the course of the pandemic, subprime buyers pretty much just got obliterated because, well, subprime buyers cannot pay over MSRP. It's not that they don't want to pay over MSRP, it's they just can't get approved on that. A lending institution is not going to give a subprime buyer a loan for over 100% loan to value on a car. Generally speaking, that's typically what you see. And so, they couldn't buy new cars anymore. And then with the massive increase in used car prices, that again kicked out a lot of these subprime buyers. And so that's why you saw the rate of car purchases made by subprime buyers just again, decrease like crazy over the course of the pandemic. But with this increase, this is showing that the market is finally starting to become a little bit more favorable for subprime buyers, which you wouldn't think would happen because interest rates are a lot higher today than they were over the course of the pandemic. But when you have dealers that are discounting cars off of MSRP brand new, and when you have a used car market that, although is increasing in the short term, has decreased from the peak, it's making it so affordability is a little bit better for these subprime buyers. And so I think that this is actually, frankly, a good thing for the market because this is going to add some volume to the market, and it could potentially, start to incentivize some of the automakers to maybe build more of those affordable cars and maybe release more incentives just to, move a little bit more volume. And, for dealers, there's frankly a pretty big incentive with some of these subprime buyers because there is some good money that can be made off of subprime buyers between the sale of warranties to them them. And then also, lending institutions that specialize in subprime buyers can sometimes pay some pretty decent flats to dealerships for sending the financing over to them. Again, just depends on the specific buyer and the specific situation. So a bit of a long-winded video, I know, but I think that there are a bunch of takeaways from this video. But the biggest takeaway from this video, I would say, is the fact that you should focus right now on shopping credit. Now, I'm not saying that you should go around and get your credit pulled a bunch, because that's not what I consider shopping credit. What I consider shopping credit is looking at credit unions and auto finance companies and banks and seeing the rates that they are currently offering, and also taking into consideration the approval rate. Like, you, after seeing this video, know that it's a little bit harder to get approved with the credit union than it is with a bank. And so maybe, going with a bank this time might be a little bit more favorable. Not financial advice, but, that's just, I feel like a car market recommendation is you always want to shop everything, right? You're shopping the dealerships, you're shopping the cars, and you also need to be shopping the financing. And you can do it in a way where you're not going and getting your credit pulled a bunch. So that's one thing that I'd say is I wouldn't just go and have a bunch of banks and, auto finance companies and credit unions go and pull your credit to see what they offer. You can find stuff on their websites. There's information out there. Anyways, I'll see ya.